CVS is down 29% year to date and over 47% since its all-time high in January 2022. So is this a great opportunity to buy the dip, or is it actually a value trap that should be avoided? In this video, we will answer this question by analyzing the CVS stock, understanding the reasons behind the stock's recent plummet, reviewing important financial metrics, comparing the stock's performance against competitors, and assessing the stock's dividend safety. By the end of the video, we will run the numbers through our valuation model and decide on an acceptable buy price with a reasonable margin of safety. Starting with the stock's performance over the last 5 years versus the S&P 500, we can see that CVS has significantly lagged the S&P, increasing only 9%, while the S&P increased 85%. However, if we compare their performance just before the stock started declining in early 2022, we'll notice that CVS was actually outperforming the S&P by over 50 percentage points, almost doubling the S&P's return until then. So, is this underperformance a result of weakening business fundamentals, or could it be an irrational overreaction from investors? Make sure to stick around until the end as we unravel this mystery in this video. When comparing CVS's performance with its competitors Walgreens, United Health, Elevance Health, and Cigna Group over the last 5 years, we see some mixed results. Cigna, United Health, and Elevance Health outperformed with returns of 119, 117, and 47% respectively, while Walgreens was the worst performer in the group, decreasing 65% since May 2019. Now, we all probably know the issues that have been going on with Walgreens. They're losing money and closing stores left and right. But what about CVS? Why is CVS down almost 50% since its highs? To answer this question, we have to start with the latest earnings report for Q1, where CVS missed both top and bottom line consensus estimates, causing the stock to drop over 17%. As you can see here, revenues came at $88.4 billion, which was short of Wall Street's expectation of $89.2 billion. However, the huge miss was in earnings per share, which came at 1.3 instead of 1.7. A significant miss of 22.8%. If we compare these results with the same quarter in 2023, we can see that other than revenues, every single metric saw a significant drop, with both GAAP and adjusted earnings per share decreasing over 40%. Not only that, the thing that really scared the market is the company's guidance for 2024. You can see here a side-to-side comparison of their previous guidance from Q4 of 2023 and the updated guidance. Basically, every single financial metric has been revised down. Revenues decreased from $371 to $369 billion. Operating income decreased from 16.9 to 14.8. GAAP EPS decreased from $7.1 to $5.6 per share. Adjusted EPS decreased from $8.3 to $7 per share, and cash flow from operations decreased from $12 to $10.5 billion. Now, obviously, no one likes to see lower guidance, as it implies that the company they're invested in isn't doing very well. But the issue here isn't really that CVS missed estimates or lowered guidance. The issue is that this has become a pattern with management in the past few years, lowering guidance year after year. Only 3 months ago, CVS's management believed that they were going to make 16 to 20% more in earnings per share, and then suddenly they realized that they overestimated their numbers. It's happening again and again, and the explanation for lowering guidance is primarily due to the impact of elevated Medicare utilization in our healthcare benefits business. In other words, they're not making as much money as they expected due to increased medical costs from their insurance business. Did these increased costs suddenly happen out of nowhere? Why weren't they anticipated earlier? I think the main issue here is that these increased costs don't only impact CVS, they impact other health insurance companies as well. However, other companies like Humana and United Health did not decrease their guidance despite these increased costs, which tells you that the problem might not be in the costs, but in CVS itself. This is basically why I believe investors are fleeing CVS. They are losing trust in management and their ability to steer the company forward and rebound from their recent bad performance. Before moving on, there's one last thing I want to point out. Notice how the revenue guidance only decreased by 1%, while earnings and cash flows decreased by at least 13%. What does this tell you? This tells me that moving forward, CVS will have lower profit and cash flow margins, which is not something investors like to see, especially that, as we will see later, CVS already has pretty low margins. Now, let's move on to CVS's financial statements to see how the company has been performing in the last 5 years. Maybe this report is just a one-off. We can see here that CVS's revenues grew from $257 billion in 2019 to $361 billion in the trailing 12 months. That's a CAGR, or a compound annual growth rate, of 8.1%. Similarly, we can see that net income increased from 6.6 billion in 2019 to 7.3 billion in the trailing 12 months, which is a CAGR of 2.3%. Now, the first thing you'll probably notice is that CVS has really low profit margins, around 2 to 3%. And although health insurance and drug retail are naturally low margin businesses, 2 to 3% is on the low end when compared to other companies in the same industries. The other thing you'll notice is that revenues have been increasing consistently year to year, while net income has been a little bumpy, dropping almost 50% in 2022 before going up in 2023 and looks to be dropping again in the trailing 12 months. Additionally, similar to what we just observed in the latest earnings report, revenues continue to increase at a faster pace compared to profits, resulting in tighter margins, which in turn could put more pressure on the stock moving forward. As for the balance sheet, we see that the cash balance in 2019 was 8 billion and increased to 13 billion in the trailing 12 months, which is a CAGR of 11.7%. Current assets, which includes the cash balance, also increased from 50 billion to 67 billion, a CAGR of 6.9%. Net debt, which is the sum of short and long-term debt minus cash and cash equivalents, decreased from 81 billion in 2019 to 69 billion. That's a compound annual decrease of 3.7%. So cash and current assets are increasing while net debt is decreasing, which is what we would want to see. However, with a market cap of 72 billion, the debt is still quite high, especially if you compare it with the company's net income. Now, it is important to mention that although it doesn't show it here, CVS's debt really spiked in 2018 due to the acquisition of Aetna, their health insurance business. Since then, it looks like the company has been paying down its debt, which is good to see. In terms of the dividend, CVS has a dividend safety score of 80 out of 100, which gives it a safe rating and implies that a dividend cut is unlikely. The company has been paying a dividend for 27 years straight without a reduction and has been increasing the dividend for the past 2 years. Now, to be fair, their dividend growth record was much better, as you can see from this graph, increasing since 2004. However, they decided to freeze the dividend from 2017 to 2021 due to the acquisition of Aetna. Despite the freeze, the dividend has been increasing 4% over the last 5 years and 16% over the last 20 years, with the latest increase coming at 9.9% in December 2023. As we see here, CVS's dividend yield of 4.6% is much higher than its 5-year average of 2.9%. Which indicates possible undervaluation. Similarly, CVS's forward PE also indicates undervaluation, with a forward PE ratio of 7.9 versus its 5-year average of 9.9. However, as always, we do not look at any metrics in isolation and will make our conclusion by the end of the video. CVS's earnings payout ratio is currently 32%, which is lower than my preferred 60% threshold. I generally want it to be less than 60% as it gives the company space to continue increasing the dividend in the future. As you know, I personally prefer to use the free cash flow payout ratio as earnings can be subject to accounting manipulation. Again, anything under 60% is the preference, and as we can see here, CVS's free cash flow payout ratio is currently 39%, which is good to see. However, we can clearly see that both ratios are trending upwards since 2021, so if you're a CVS investor, you probably want to keep your eye on them to ensure that they remain at reasonable levels moving forward. Shares outstanding have increased from 1.17 billion shares in 2014 to 1.28 billion shares today. That's a 9.4% increase in shares outstanding in this 10-year period, meaning that CVS has been issuing shares and diluting existing shareholders, which is the opposite of what we would want to see. Most of this increase happened in 2018, probably to fund the Aetna acquisition, and it looks like management started buying back shares in 2021. However, in the latest earnings call, Thomas Cowhay, who is CVS's Executive Vice President and CFO, mentioned that they do not expect to repurchase any additional shares in 2024. So shares outstanding will likely remain at these levels until the company gets things back on track. Now, again, to me, this is another red flag from management. If you invest in a company, you want it to be buying back shares when the stock is at its cheapest. But when we take a look here, management was buying back shares when the stock was at all-time highs in 2022 and then decides to stop buying after the stock drops 50%. It doesn't really make sense at all. Now, coming to my favorite metrics, return on equity and return on invested capital. And just in case you're new to the channel, a high return on equity usually signifies a company's moat, while the return on invested capital reflects management's ability to effectively allocate and reinvest capital. I generally like to see a minimum of 10% for both metrics, and as you can see here, both metrics are more or less hovering around that threshold, averaging 10.7 and 11% respectively over this 10-year period. However, you'll notice that both metrics dropped in 2018 and are yet to recover back to their previous highs. In terms of operating and free cash flow margins, as I mentioned earlier, CVS has pretty low margins, and as you can see here, the operating margin have been on a steady decline since 2022, and the free cash flow margin has dropped 60% since 2021. Yet another red flag that tells me that either CVS does not have pricing power or that the company has poor management. To me, both are reasons to avoid investing in the company. As for net debt to EBITDA, which is earnings before interest, taxes, depreciation, and amortization, I generally like to see it under 3 for most companies, and it is currently over that threshold at 3.16, and expected to rise even further to 3.27 in the next 12 months. You can clearly see that it spiked in 2018 due to the acquisition, declined until 2022, then started rising again. We observed the exact same thing with net debt to capital and interest coverage, spiking in 2018 and declining until 2022 before rising again. So other than a nice dividend yield and relatively low payout ratios, I personally don't see anything attractive about these metrics. And with how things are going, I wouldn't be surprised if management decides to freeze the dividend again and maybe even cut the dividend if margins continue to be squeezed. One last thing to check before moving on to the valuation models is how did CVS perform in the last recession of 07-08, especially with the ongoing speculations of a recession in the near future. As we can see here, CVS actually increased the dividend during the recession. Its sales decreased by 2.5%, which was above average growth, and the stock actually beat the S&P 500, declining 38%, while the S&P declined 55%. Jumping into our valuation models, we'll be reviewing 4 distinct models to get our intrinsic value and acceptable buy price. If you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified once we release similar videos in the future. Our first valuation model is the discounted free cash flow model, where we estimate CVS's intrinsic value based on the present value of their estimated future cash flows. You can see here the free cash flow that CVS generated over the last 10 years, growing at an average of 9% per year. Based on analyst estimates, we use a 2% growth rate for future cash flows. Using an 8% discount rate, we get the present value of all future free cash flows as well as our terminal value. Adding them together, plus cash and cash equivalents minus total debt, we get our enterprise value, which is the estimated total value of the company. Dividing the enterprise value by the total shares outstanding, we get a fair value of $98 per share, which is higher than CVS's current stock price, indicating possible undervaluation. Now, if you want a higher discount rate, say 9%, to match the historical returns of the S&P, your fair value would decrease to $73 per share, which is still higher than the current stock price. For this video, I'll keep the discount rate at 8%. However, if you would like a copy of these valuation models to use your preferred discount rates and change any of my assumptions, you can now get one using the link in the description below. The second method is the multiples valuation model, where we obtain CVS's fair value based on the multiples of its competitors and companies within the same industry. We do so by getting their current PE multiples, calculating the average PE, and multiplying it by CVS's earnings per share to get our fair value, which is $153 per share, which is 3 times the current stock price. The fair value is so high because CVS's competitors are trading at much higher multiples compared to CVS. In the last 10 years, CVS traded above a 25 PE only once in 2022, so I think valuing it at an average 26.8 PE is probably unreasonable. Therefore, I think it's best to exclude this model from our intrinsic valuation so we don't skew our results. However, feel free to include it in your intrinsic valuation if you believe that CVS will trade at these higher multiples again in the future. The third method is the dividend discount model, where we estimate CVS's fair value based on the present value of future dividend payments. You can see here CVS's total dividend paid per share in the last 5 years, which grew on average 5% per year. Now, given CVS's recent financial challenges, I don't think they'll be able to sustain high growth rates, so I'll keep it at 5% for future dividend payments. Discounted at 8%, we get a fair value of $85 per share, which is still higher than the current stock price. The last method that we will review today is the historical multiples valuation model, where we estimate CVS's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we will use the 5, 10, and 20 years normal PEs. As you can see here, the CVS stock was trading at an average 10.1 PE during the last 5 years, 12.1 in the last 10 years, and 14.3 in the last 20 years. We calculate their average and multiply it by CVS's current earning per share to get a fair value of $69 per share, which is also higher than the current stock price. You'll notice that the average PE over the 3 periods did not exceed 15, which supports our decision to exclude the multiples valuation model from our intrinsic valuation. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 3 fair value estimates generated by our models. The intrinsic value we get is $84 per share, which is higher than the stock's current price, but lower than its 52-week high. Without a margin of safety, the stock would be a buy at the current price. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies with a wide moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $76 per share. Now, with all the financial challenges and managerial issues that we've discussed, you might want to consider a higher margin of safety. For a 15% margin of safety, the acceptable buy price would be $71. If you are looking for a 20% margin of safety, your buy price would be $67, which is still higher than the current price. Basically, based on my assumptions, CVS is currently trading at a 31% margin of safety. But does that mean it's an absolute buy? Well, I am not a licensed financial advisor, so I will leave that up to you to decide. But I will remind you about Warren Buffett's famous quote, where he said that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Personally, I don't believe CVS is a wonderful business. I think that it's a fair company at a wonderful price, so it's not really a buy for me despite the significant undervaluation. However, I have to admit that insurance and drug retail businesses are not really within my circle of competence, so I am curious to hear your thoughts about CVS. Let me know in the comments below whether you believe CVS is a wonderful or a fair business. Maybe there is something I am missing. And again, if you would like a copy of the valuation models used in this video, feel free to get one from the link in the description below. In terms of Wall Street's expectations for CVS stock, they are forecasting it to trade at $72.4 per share in 12 months, which is lower than our estimated intrinsic value, but higher than the current price, implying a 25% potential upside for the stock from current levels. With that being said, if you enjoyed this analysis, don't forget to like and subscribe and watch my other stock analysis videos. Thank you very much for watching. Until next time.